CPI inflation low, but offers little encouragement for Fed or markets. The CPI inflation report for the month of August was essentially flat month-on-month with a 0.1% increase in prices broadly in line with expectations. However, the underlying trends were more concerning for Fed policymakers. Low inflation was driven almost entirely by sharply falling gasoline prices. Most other major components of inflation saw price increases. The Fed cares more about underlying inflation than temporary swings in energy costs and will take little comfort from the report. After today's report, U.S. annual inflation stands at 8.3%. Markets are also now seeing a chance of a 100 bps per second hike later this month, though 75 bps per second remains the most likely outcome, based in interest rate futures. Many important parts of the CPI index rose in August, and there is concern that when any swings in energy costs roll off, underlying inflation will remain higher than the Fed wants to see. Food, shelter, cars, medical costs and furniture all saw material price increases for the month. This matters because today's report may not give the Fed sufficient comfort that their work is done, hence further rate hikes could be coming. The Fed wants to see a broad range of prices signal that the wave of inflation is past. That's not a conclusion that's easy to draw from the CPI report. Still, the CPI report was not entirely negative. Of course, the low month-on-month rate is good news, and falling gasoline costs are far more welcome than the reverse. Even though food costs rose 0.8% for the month, which is high, that's still the lowest level of food price inflation that we've seen in many months. Also, airfares and used car pricing continued to decline. However, fundamentally, the Fed wants to see signs that overall inflation is cooling in the U.S., and the CPI report didn't offer that on most assessments.